you actually have to set it up from the IRA to pay the mortgage company or the loan servicer.
Hmm.
And so, but that's, you just talk to, it's usually called like an expense pay or recurring pay, something like that. And then it's just very easy to do. It's set and forget. And then you just watch your account grow. I like that.
That sounds lovely. That sounds like passive income. All right. So
It's yes. But so with the IRA that you can't take, well, if it's a Roth IRA, you could take it out at 59 and a half without any taxing implications.
Mhm.
But in your regular IRA, it's different. But those again are all IRS rules. So it's passive income for when you're retirement age, I guess.
Okay. All right. So Margaret Smith has a couple of good questions here. Alyssa keeps these properties until she dies. She can pass them on to named beneficiaries who can keep them going tax-free in the case of her self-directed IRA, right?
So I think I'm not exactly sure, but I think how it would work, and I only know this because of my mom also passed in 2013, which is a bad year for me and Mike. So she had like an investment account in stocks and stuff that I know nothing about. And so I was able to take it and create a self-directed IRA that was inherited. And so, but all the assets that were in her IRA, her 401k, or was it an IRA? I can't remember. It's a while ago. But all that stuff came to me in a stepped up value. And so I imagine that you probably need to have that somewhere. And maybe Greg is the better person to speak to this.
You
And
know,
that's a really great question. I'm going to ask my custodian now to find out, because I would like to leave my holdings to my nephews. And if my dog is still here, her too. Because I don't want her to have Publix dog food. I want her to have the cream of the crop. But aside from that, like that would be my choice. And so I don't know if some extra things need to be in the property itself, you know.
and I'm going to defer to a CPA on this too. I know enough to be dangerous, but when we're getting into inherited IRAs and the step up of the cost basis, I know there's something there, but I'm not an expert on it. And I would really encourage you to reach out to your CPA to find out, because there is something there. And I think it's incredibly valuable, but I'm probably not the best authority on it.
All right. So Lee Bishop says in the chat, we inherited Roth IRA and had to pay tax on it and had to make withdrawals. So there's one data point. Margaret
Yeah.
Smith also puts in, those beneficiaries can keep the income coming in tax-free if they choose to keep the properties rather than cash out. And then she asks, what is the latest rule? Is it 10 years for SD IRA to keep tax-free income tax-free now?
I think so, on inherited IRAs.
On inherited IRAs, 10 years. So
Yeah.
give me some context. What does that mean? You have to inherit it and then hold it 10 years, or they have to have
Yes,
been held for 10 years?
you have to liquidate it in 10 years.
Got it.
Because you cannot, as the beneficiary for an IRA, you cannot contribute to it. And so when I inherited my IRA, the rules were different. So I could take as long as I want and just take the required minimum distribution every year, which I hate doing because I'd rather reinvest it, but they won't let me. So I have to take money out, which really makes me upset. But, the government wants their money. So whatever. But I think now that as of 2020, so end of 2019, 2020, it switched. So I think you have to deplete it in 10 years. And I don't know I don't know how, I guess you would have to sell. I don't even know. And I don't think anyone else is going to be giving me an IRA, so I won't have to know. There's so much I have to know that I'm just going to leave the stuff I don't need to know out there.
I think that makes a lot of sense. Babby Meekins asks, if it's a Roth IRA, are profits and depreciation of investment not taxable?
If it's a Roth,
Yeah.
the profits aren't taxable.
Okay. And appreciation of investment?
I can take that one. So if you're in a Roth IRA, you're already not paying taxes on the gains, which is the goal. And so the reason why we love depreciation from a tax perspective so much is because we're trying to get to a state where you can defer taxes. And you really can't get to a state where you're eliminating tax. Like you don't have to pay the gains on it. The best you can do with depreciation is just defer them until you would eventually sell. When you're investing in a Roth IRA, you're already miles ahead of that because you're investing in a scenario where no matter how much you make on the gains, you don't have to pay taxes on it. So it's another way of saying you're already there. You're already miles ahead of where you could be if you took depreciation. So you do not get to take additional depreciation on top of that. So the technical answer is no, you don't get to get depreciation, but the real answer is who cares? You're already there. You're already getting better tax advantages because you're investing in the Roth IRA.
So can I tell you what I did with one of my properties?
Yeah.
It was in my traditional IRA, and I knew I wanted to kind of grow my Roth IRA. So I was able, so that the property that I own 50-50 with Mike, I don't own, my IRA owns. It's just like a shadow of you or an entity or your imaginary friend, right? Has its own tax ID, has its own everything. I actually converted it because now I don't have a W-2 job. And so I'm in a lower tax bracket. So I converted my half of that house from my IRA to my Roth IRA. And yeah, it's, so now that's really nice because it's growing there. And that was one of my original three.
Mm-hmm. 3 houses with JWB.
Yes.
Yeah.
Because you offered a deal if I got 3. And so
Yeah.
it was like, that's why I had to get Mike involved.
There we go.
Because
I think I
didn't
was
have
working
enough.
with you on that one. We were coming up with something creative, weren't we?
Yes. Because
Yeah,
I
back
was
in the
like,
day.
I knew I needed to get that deal.
Yeah,
So
that's right.
it was like
We still do
$1,000
that for other
off.
people. We still have incentives for multiple purchases. So there you go.
Okay. Yeah. So
what are those? I got a little bit lost in all the different types of IRAs and what that mechanics was. Can someone explain to me? Like,
Yeah.
actually, can you tell my friend, who doesn't really understand how what all that meant? Like when she moved it from one IRA to another, what's the difference?
Yeah. So I'll take this, Alyssa. So basically, there's a great strategy that you can do. If you're investing with your traditional IRA, what you're doing is you do have to pay the taxes at some point later on when you get to be 59 and a half and you start to distribute the money from your IRA into your personal bank account. That's taxable. That would show up as income earned on your taxes at that point that you took that distribution. And so what Alyssa did is said, based on her career situation at that time, her income bracket at that point was really low. And let me know if I'm way off base here.
no,
Alyssa.
that's it.
Yeah. So you're looking at your income bracket.
And always looking for a deal.
Yeah. And it's really smart. And she says, okay, well, if my income this year is way low and that's temporary, then I'm just going to go ahead and convert this from a traditional IRA to a Roth IRA. And that's something that people can do. What you need to do is then you just need to pay the taxes. So it shows up as income for her in that year that she pays the taxes on that year. But because it was a year where she didn't earn nearly as much as she normally does, her tax bracket was low that year. So it was a strategy to pay low taxes on the traditional IRA, get the taxes out of the way, and now that money is in a Roth IRA. And a Roth IRA then can grow tax-free for her. So it was a very advanced strategy to do that.
It's not so advanced because I could do it. So
don't sell yourself short there.
No.
It is. You are so humble and you don't give yourself credit, but like what you're talking about, you own 9 properties in Jacksonville. And in addition to everything else You're revitalizing your own neighborhood here. You're revitalizing Jacksonville neighborhoods. Like, give yourself a little credit there, Alyssa.
I'm trying. But the other thing that's good about that strategy, because you are Jacksonville wealth builders, there's probably a lot of wealthy people on this call. And so they may be over the income level to contribute to a Roth IRA. So it's a sneaky way. I think it's called a backdoor IRA or backdoor conversion or something like that, where you buy it in your regular IRA, your regular self-directed IRA. And at some point, you can then use the back door and then do the conversion and pay the taxes.
Mm-hmm.
But if you own properties in your IRA and yourself, like in your name, you could also do like an advanced depreciation to bring it's like cost something.
Cost segregation analysis. Yeah.
Yes. And that allows you to like reduce I guess you take your depreciation sooner, but you also decrease your income sooner so that when you have to pay the taxes on your Roth conversion, it all comes out kind of in the wash.
That's pretty much the most advanced thing that we've talked about on the Not Your Average Investor show from a tax perspective there, Alyssa.